You ever see one of those giant companies, I'm talking $100 billion massive, and just wonder, what's really going on in there? Well, today, we're going to pop the hood. We're breaking down a detailed analyst report from Morningstar on Brookfield Corporation to see what they've found.
And that's the big question, right? Is this behemoth a good investment? The good news is Morningstar has an answer. And we're going to unpack it piece by piece so it all makes perfect sense. We're going to find out if this giant is a buy, a hold, or maybe something you should stay away from.
So here's how we're going to tackle this. First, we'll get the analyst's toolkit down. Then we'll meet Brookfield, dive into their valuation story, see if they have a competitive edge, and then the final verdict for Morningstar. Simple. Okay, so before we can really dig into the report, we got to speak the language, right? You need to know the tools the analysts are using. Think of it like getting the secret decoder ring. We're going to start with 3 key ideas that are super important.
First up is something called the fair value estimate. Now, try to ignore all the crazy market swings for a second. This number is what the analyst thinks one share of the company is actually worth. It's like the expert's sticker price on a car. And the big question is always, are you paying more or less than that sticker price?
All right, next up is the economic moat. And honestly, this is one of my favorite concepts. Just picture the company as a big castle, okay? The economic moat is that huge, wide ditch filled with water surrounding it. It's what keeps the competition from storming the gates. It's their competitive advantage. And the wider that moat is, the safer the castle, and its profits are going to be for years to come. And that brings us to the star rating. This is where it all comes together. After looking at the fair value, the current price, the size of that economic moat, everything, Morningstar basically gives the company a final grade, a score from 1 to 5 stars. It's the TLDR of their entire analysis.
Okay, now that we've got our toolkit, let's meet the company we're looking at, Brookfield Corporation. And listen, this is no small fry. We are talking about a massive global player.
So what's their deal? Well, with a market cap of over $100 billion, these guys are an investment firm that buys and runs the stuff that makes the world go round. We're talking about the actual backbone of the economy. Things like infrastructure, renewable energy, huge real estate deals. They're all over the globe, but the US is where they make their biggest splash.
All right, time for the main event, the valuation. We know who Brookfield is, but what are they worth? Let's get into the numbers from Morningstar's report and ask that classic question, is the price right?
And just look at this chart. It tells the whole story so clearly. That black line, that's what people are paying for the stock day to day. But the red line, that's Morningstar's fair value estimate, that sticker price we were just talking about. And you don't have to be a Wall Street analyst to see that the black line is pretty much always floating above the red one.
Yeah, and it's not a tiny gap either. The report puts a number on it for us. The stock is trading at an 11% premium. What that means is, right now, the price on the market is 11% higher than what Morningstar's deep dive analysis says it should be.
And here are the raw numbers, which just makes it crystal clear. The current market price is $46.59, but Morningstar's fair value, $41.53. That $5 gap on every single share, that's the whole story in a nutshell.
So you gotta ask, why is Morningstar so cautious? Well, they point to a few red flags. For one, a lack of profitability. Then there are some weak valuation metrics. And they even mention that the recent jump in the stock price could be what's called a bull trap. You know, luring investors in right before a drop. And get this, they even say there's medium uncertainty about their own fair value number.
Okay, let's look at the numbers behind that whole lack of profitability thing. See the revenue? It jumped up in 2023, which looks good. But then, look at net income and return on equity. Yikes, they basically fell off a cliff compared to 2021, and the forecast says they're going to stay down there. So what this tells us is the company's getting bigger, sure, but it's not getting more profitable for the people who own the stock.
All right, so the valuation's a bit of a worry, but what about its ability to defend itself in the long run? You know that castle we talked about? Does it have any defenses? Let's check out what Morningstar has to say about Brookfield's economic moat.
And here it is. On the left, you see the symbol for a strong competitive advantage, a castle. And on the right, Morningstar's rating for Brookfield, none. That's right, they're basically saying this $100 billion giant is a castle with no walls.
And the report doesn't mince words on this. I'm going to read this quote directly because it's just so crucial. It says, with its
Quantitative economic moat rating of none, we do not expect this company to materially out-earn its cost of capital in the long run.
Wow.
That is a heavy statement. It's saying that over the long haul, this company is probably going to struggle to create any real, lasting value. And just so you know, this isn't some new problem. If you look at this historical chart, you can see their moat rating has been kind of all over the map. It's been bouncing back and forth between narrow and no moat for years. It shows there's just no consistent, durable competitive advantage here.
So let's recap. We have a stock that looks a little pricey and a company that doesn't really have a competitive edge. So let's put it all together. What is Morningstar's final verdict? Is it a buy, a sell, or a hold?
And the final score, the big summary of everything we've just walked through, is a 3-star rating, right smack in the middle. Not great, not terrible. So what exactly does a 3-star rating translate to? Well, in plain English, it's a hold. Look, Morningstar isn't screaming sell from the rooftops, but they are absolutely not saying you should be buying it at this price either. They basically think the price is fine, but with all those big buts we just talked about.
So here's the real takeaway. It's kind of funny. Morningstar calls it a balanced choice. But then right after, they say prudent investors should consider looking elsewhere. And you have to ask why. Well, it's because the price is a little high for its weak profits, and this is the big one. The company has no economic moat, no long-term defense for its business.
And all of this leaves us with a really interesting question, doesn't it? I mean, Brookfield is enormous. It owns critical pieces of the economy that we all depend on. But if it can't reliably turn all that size into actual profit, what is it really worth? It really makes you think. In the game of investing, what's more important, being huge or being able to build an unbreakable fortress of profit?